Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, tens of thousands of organizations could be affected by a hack of Microsoft's SharePoint software. Plus, all eyes on Tesla, Alphabet, IBM this week as big tech earnings get underway and stock benchmarks hit new records. And how Tesla, SpaceX, and xAI are struggling to deal with the fallout from Musk's feud with Trump and his wild bets. But first, one key stock we're looking at, which is managing to shrug off initial anxiety that you saw at the start of trade around this global vulnerability. SharePoint, the software where you can be, it's a data management application for Microsoft, and indeed it could be exposed to hackers. Tens of thousands of businesses could be affected. Let's get to it. Bloomberg's Brody Ford. And it's not a share impact, but it could be a real impact for users.
That is absolutely right. If you have a coworker who sends you a file, there's a good chance it's on SharePoint. I mean, this is a very well-used, pervasive program from Microsoft. And what is interesting about this situation is it is about 1 year after a very fateful day for Microsoft, which is when that issue with CrowdStrike caused all those flights to go down. And so Microsoft's cybersecurity division has had a lot of heat lately. Today, it just got a little hotter.
It did. Over the course of the weekend, the U.S. Cybersecurity and Infrastructure Security Agency, CISA, put out this warning. And it's not the first time that the U.S. government has called out Microsoft for these sorts of vulnerabilities.
Absolutely, and you could say that this is a really small subset of customers likely, right? This is folks who are using SharePoint on-premise. That's likely a small subset of the larger group, and it's those who maybe should have updated to the cloud and this maybe wouldn't have happened. But it doesn't matter, right? If you're a customer and you got your SharePoint hacked, and now you have hackers going between your files to your teams and pulling out emails and God knows what, you certainly might take a second look before staying with Microsoft for certain security products.
Has Microsoft responded, and how?
Well, they've sent out some instructions on, hey, here's how to patch your system, here's what to do if you think you may have been impacted, but this is a pretty quick moving thing. I mean, also Microsoft earnings are next week, and so I'm certainly expecting to hear some questions about, hey, is this impacting any kind of customer behavior yet?
Census, Silas Cutler in your story saying it's a dream for ransomware operators.
Yeah.
Bloomberg's Brody Ford. Fantastic.
Thank you.
Thanks for reporting on it for us. Meanwhile, let's just get a bit broader, because we were just hearing from Brody that big tech earnings are coming up. Indeed, Microsoft is one of them. Amazon, that's happening later this month too. This week, we've got Tesla, Alphabet, IBM, to name but a few. Let's bring in Bloomberg's Denitsa Tsekova. Denitsa, look, are we expecting revenue to be improving for the likes of Alphabet at least? I know that Tesla's a different story, but let's talk on about Alphabet.
We actually saw an upgrade on Alphabet from Morgan Stanley. They're very optimistic both on Alphabet and Meta, but they're upgrading the price target at Alphabet just because the valuations of Meta is pretty high. But what we're seeing now, we're obviously at record highs. S&P trades at 22 times forward earnings. Just incredible rally here. We're also seeing a very high bar. There is a big punishment for those who miss on earnings, the biggest in 3 years. And for those who actually outperform, it's like the best in about a year. So the bar is higher, especially if you disappoint. Artificial intelligence spending has really made a big difference in the Magnificent Seven. We see Meta, we see Microsoft and Nvidia leading the gains, and obviously Apple is struggling. Amazon is another interesting story. They're up just about 3% year to date, which compared to the incredible spending Meta did and the reward investors have given to that, the company is up more than 20%. So we're seeing a big gap opening, and with this year earnings season happening without too many economic reports, too much happening in the macro, it's all about the earnings right now.
And I love that you bring up the spending that Meta has done, because Bloomberg Intelligence, Mandeep Singh, writing that Alphabet, we are anticipating maybe even an increase in capex coming from them. We're also anticipating, of course, the fact that they've boosted some of the prices of their ad targeting. Maybe that's going to be reaping dividend. You can go and read more about the preview that our colleagues over at Bloomberg Intelligence have. But he said, go back to maybe the other key proof point this week is Tesla. Now, what's interesting is sometimes the fundamentals don't matter for this business. business. We expect revenue to fall, profitability to fall. But it's more about what Elon says.
It's really fascinating because he was very active this weekend. He was saying he was working 24/7. He's even sleeping there. We actually didn't saw big reaction today. In pre-market, there was some optimism, but today the stock is actually down. We also have news that Tesla is set to fight California Department of Motor Vehicles over their claims that the company has exaggerated their capabilities of self-driving. And no, we're not seeing a major move. Obviously, after that quarrel with President Trump, the stock was under a lot of pressure. It has recovered some of that, but there is a whole universe of investments tied to Elon Musk that has been under pressure and hasn't received that big social sentiment we saw after the election in the beginning of the year. So with that boost absent, the question is whether investors will really penalize a miss in earnings.
Particularly the retail fans. We're going to dig into Tesla much more in a moment with Max Travkin, but with the numbers was Denitsa Tekova. We thank you very much. Now let's just bring you a broader perspective as we think about earnings, we think about idiosyncratic news like Microsoft's. Michael Reynolds is with us. He's Vice President in Investment Strategy over at Glenmead. You've got a cool $45 billion in assets under management. And Mike, I go to you first about the optimism already baked in the market. We're at record highs again. How high is the bar for earnings this week?
Thanks for having me on. The bar is pretty high as we come into Q2. It seems like a lot of companies are really posting some or expected to post some results that are relatively resilient, especially compared to where people thought tariffs were going to be in early April. The thought that was going to hit margins pretty materially. We're looking at Q2 numbers in the aggregate that are actually holding up pretty well. S&P 500 expected to post 5% earnings growth on a year-over-year basis. Tech is a pretty big contributor to that, and they may be relative beneficiaries from the tariffs that have been announced and have gone into effect so far. So overall, the story of earnings season, as the rubber's hitting the road, is resilient so far, almost surprisingly so.
Resilience for the large cap winners of the AI trade, in particular I think of Nvidia, in particular I think of Meta, but we have started to see this bifurcation in the Mag 7, for example. Tesla has not overperformed this year and indeed is a key laggard. So too is Apple. How are you seeing that being played out from an investor sentiment perspective?
An excellent point. We're not just bucketing the Mag 7, we're looking at broader tech here, and there is this bifurcation. In large cap, Mag 7 overall, again, some aren't contributing, are a really big driver of the results for the S&P 500. But if you look over into small caps, actually, some of the biggest contributors for pretty notable gains in earnings for Q2 are expected to be financials and healthcare. So what that sort of tells you is it's really not just a broad tech play for earnings resilience this quarter. It's actually a little bit more company specific, which is a bit of a departure from what we saw last year, where in the aggregate, Mag 7 just blistering earnings growth. And you're starting to see some of that falter a little bit, deceleration in the aggregate, and some companies just having a little bit of a tougher go of it.
In terms of a tougher go of it, just think back to last week in Netflix. I mean, they managed to post some really solid earnings, but they were punished largely because of just how well they've run up. Is there a risk that companies don't even underperform? They actually manage to beat, but not well enough?
Sure, that's an inherent risk when you have companies that are valued so to such a premium extent that they have such high, let's call it price to earnings ratios, that you bake in a growth rate to those earnings, and if you can't meet those hurdles, there's often a big punishment for failing to meet those results. There comes great expectations with great valuations. And so if you're showing signs that perhaps down the road we're not going to be able to meet some of those earnings growth expectations, there's a re-rating that has to happen there. And it's an inherent risk investing with, again, growth stocks or premium valuation equities.
And regulatory risk overhangs a lot of these big names. I think of Alphabet in the line of fire when it comes to investigations as to whether it's a monopoly in certain areas of its business. You think about Tesla and the ongoing need for more regulation around robo-taxis in the future. That affects Waymo too. How much do you have to factor in regulation right now, Mike?
Regulatory risk is so important, especially when you have such a concentrated market as we have now. Right now, we have one stock in the S&P 500 that has an 8% plus weight in a 500 company index. We've seen this two other times in the 60s. You had AT&T and you had IBM. What happens is when you get to such a scale, you have a target on your back. And that can be a regulatory target, and that could also be a competitive target. So these are things that you have to think through when you're looking at a company that dominates an index. They have a target on their back, and you have to sort of think through the implications of what that can have to future earnings growth and future dominance of the company.
Thus far, NVIDIA stays higher up about 0.25%. In fact, Apple getting a little bit of wind beneath its wings for this particular week. But Mike, I go back to what you said about small caps. Look, we're a tech-focused show here, but the fact that healthcare and the fact that financials outperform, how much that's starting to be the fact that AI will be beneficial and that will help revenue growth and maybe profitability as well?
It's an excellent point, because we've seen some of the initial beneficiaries of AI been those that are developing the technology and providing the hardware for that technology. But ultimately, that's going to be something like the internet that permeates through every company. And there's got to be this thought process across the spectrum that AI is going to be a beneficiary for these companies, and it's going to penetrate throughout C-suites, throughout the economy. So is it a little early to perhaps being able to see some of that penetration happen in real time for some of these companies? Perhaps. But some of these early movers could start to see some benefits onto their bottom line.
Look, we're a global network as well, and we talk so much about the US winners, but I think about what TSMC is doing with its valuation hitting more than $1 trillion over in South Korea. When you're thinking about European bets, Mike, how much are you seeing investors want to get global with their tech exposure?
We're seeing quite a bit of that, especially around the dollar in particular, where we're looking at portfolios in some cases that, if they're very U.S. focused, we're arguing if you don't have a single investment in your portfolio that's not dollar denominated, you're not properly invested. And so when we're going to look for these opportunities abroad, it's not just what are the company specific opportunities, but more on a macro basis. If we do find ourselves in a declining dollar environment, you're going to really wish you have non-dollar denominated assets in your portfolio. May some of that be AI plays? Perhaps, but more broadly, it's just more important that you're looking abroad for a global opportunity set within your equity portfolio.
Michael Reynolds, Vice President of Investment Strategy at Glenmead. Great to catch up with you. Thank you. Now coming up, how Tesla, SpaceX, xAI, they are struggling to deal with the fallout from Musk's feud with Trump. That's next. It's the Business Week front cover. This is Bloomberg Tech. Elon Musk's feuds and wild bets, well, they're having an impact on the billionaire's businesses, including Tesla, SpaceX, xAI, and that is the focus on the Bloomberg Big Take. And it's Bloomberg's Max Chafkin and our own Ed Ludlow that co-author it. Max joins us right now. It's a great story. It's the lead of the Business Week cover as well. And you go into the case studies of just how what has been a very public spat has fallen out into some key future crises for these companies.
Yeah, absolutely. So you do have this feud with Donald Trump, which is a big deal. I mean, I think you look at why has Tesla stock fallen over the past 6 months or so. A big reason of that is it's kind of like it hit a high just after the election, and we've had kind of a reverse Trump trade. But once you back away from the Trump of it all, you start to see three key companies, SpaceX, Tesla, X, all of which are attempting these huge, kind of monumental things with huge amounts of risk. I think it's a thing that Elon Musk has never tried to do before, really. We've never seen this in his career. As much as he's a guy who makes big bets, we have Tesla attempting to do a hard pivot away from car manufacturing to robo-taxis, a competitive field, a field where they're not necessarily in the lead. We have Starship, this giant rocket, which has yet to fly yet. We've had 3 successive explosions during test flights. And then we have X, which looks very promising, xAI, but I think is clearly a little bit behind some of its competitors, OpenAI and Anthropic, and is losing huge sums of money. And you take all those 3 things, and then you take a poor relationship with the guy who's in power in the United States, and that is a dangerous recipe, I'd say.
And it's a dangerous recipe that investors now stare down the barrel of as earnings come up this week on Wednesday. He's already declaring he's sleeping at the office, largely to fix Is it Tesla at the moment? Is it XA? How do we know where he's spending his time?
Well, that is the thing. And as Ed and I talk about in this story, I think if you talk to different people at different companies, they'll say different things. I think Tesla employees, a lot of them feel that Tesla is Elon Musk's main priority. XAI employees kind of would say the same thing. I think SpaceX is in a slightly different position because you do have sort of a strong executive more or less in charge. That's Gwen Shotwell, the president and COO. But there is that tension. And we saw that come up, in the last couple of weeks. We've seen investors suggest that maybe Tesla needs to give Elon Musk even more equity to sort of persuade him to spend more time at Tesla, which is a strange thing when you're talking about a stock that's gone down, when you're talking about all of the challenges this company faces in terms of the core business, the car business, which has not been performing well over the last year or so.
And you really articulate how much just general sentiment towards Musk as what had been the most adored entrepreneur has completely depleted, but he still has such a big base of retail supporters. Is that fading in this current moment? How much does that have to be an anxiety?
I mean, you look at Tesla stock, and it's still not doing that poorly considering all of these kind of challenges that I've brought up. So the stock is still very, very expensive compared to other car companies. It hasn't, done especially badly over the last month or so. So there is this base of support, but I think you hit the nail on the head, Caroline. The big change here for Elon Musk is he went from being a very popular, admired guy to being unpopular. When you look at his approval ratings, they are poor. And it's possible you don't necessarily need to be popular to succeed in business, but it doesn't hurt, especially when you've made your own personal brand so important to your companies as Elon Musk has.
And when your biggest fan from an analyst perspective, and we know gives short shrift to Wall Street, but when Dan Ives says, pay the guy more, and he says, shut up, Dan. Bloomberg's Max Chafkin. It's a great piece. I urge you to go read it. It is time now for Talking Tech. And first up, app design software maker Figma and some of its investors are looking to raise $1 billion in its US IPO. In what could be one of the biggest listings of the year, it could value the company up to $13.6 billion based on filings. The move comes after the planned sale to Adobe, remember, fell through in 2023. Plus Uber, well, it's suing a group of lawyers and medical providers in LA, alleging they made fraudulent insurance claims that cost the company millions in legal fees. Now, Uber accused the defendants of directing passengers to pre-selected medical providers who submitted inflated bills to treat negligible or non-existing injuries from minor collisions between 2019 and 2024. And the crypto exchange, backed by Peter Thiel, that's bullish, has filed for an IPO too. The offering is being led by JP Morgan, Jefferies, and Citigroup. It's the latest company in the growing crypto market pursuing a public listing this year. Look, there's another company set to access crypto via public markets, the Ether Machine. The firm is a combination of Dynamics and the Ether Reserve, creating an Ether treasury with over 400,000 Ether tokens. Here with more is Andrew Keys, Ether Machine chairman, co-founder. Andrew, there are a fair few companies doing this digital asset treasury play. Why are you the one to go with?
So we are not a buy and hold treasury. We are an institutional vehicle that is generating risk-adjusted returns, actively managing Ether.
Okay,
Ether is a productive asset, unlike Bitcoin. And in having Ether on our balance sheet, we have to stake it and use it to participate in the decentralized financial economy, where we're able to actively generate yield.
Okay, you're also not the only one that's looking to bring yield. I'm thinking what Bitmine and others are doing out there. So how do you distinguish yourselves as the experience with which to allocate, the experience with which to drive yield? I know that you're age-old in the ETH space and a co-founder of Consensus, but the CEO of Consensus and the guy who co-founded ETH is backing another one.
Yeah, so we have amassed the Avengers of Ethereum. Our technology team is unparalleled in experience and the creation of proprietary technology to generate this yield. And basically, we're able to outperform the exchange-traded funds that don't have yield and the ETPs that are only able to participate 50% capacity in staking. And we are able to stake, which is the only thing that the ETFs would be able to do, restake, which is using Ethereum's proof of stake mechanism to secure other middlewares, and then use Ether as pristine collateral in the DeFi economy to further generate additional yield.
What's interesting is this is almost about a little bit of PR for the Ethereum ecosystem more broadly. You talk about it catalyzing the ecosystem, and you've got some big institutional strategic players who've come on board with this particular initial announcement. I think in Pantera, I think in Kraken. How long do they hold? How long do they stay with you after the SPAC is completed and you continue to trade?
So all of our capital partners, we believe, are long-term money. We had no fast money in this vehicle. And these are other people that believe that Ethereum is essentially the next generation of the internet. With Bitcoin, you have one asset that is moving on that ledger, the Bitcoin. With Ethereum, you can have and tokenize infinite assets, such as stablecoins, real-world assets like parcels of lands, stocks, bonds, derivatives. And with those tokenized assets, you can deploy them into what are called smart contracts. So arbitrarily complex legal agreements. And we believe that Ethereum is in the earliest innings of the next generation of the internet.
It's interesting that ETH has so lagged Bitcoin as an institutional play, though. And we just think in the recent years, we have seen it just not perform in the way that Bitcoin has as an institutional asset. But now you get the Genius Act, potentially going to give more regulatory clarity. Now you get the bet on DeFi. How do you think, though, it can perform against Solana or other rival protocols, briefly?
So Ethereum is the largest beneficiary of these regulatory tailwinds because Ethereum is where these assets reside. 90% of stablecoins and high-quality liquid assets reside on Ethereum, whereas only 10% are splayed between the other blockchains. And furthermore, we believe that Ethereum is poised to have essentially what we call a gravitational pull, where more of these assets are going to be settled on top of Ethereum.
Andrew Keys, the Ether Machine, chairman of it, thanks for joining today. Meanwhile, talk about Polymarket, the crypto betting platform that was kicked offshore by federal regulators. It's just struck a deal to return to the United States markets just weeks after prosecutors shut down a probe of the company. How is it doing it? Sources say it will buy a little-known derivatives exchange called QCX, which will allow Polymarket to legally re-enter the country. Welcome back to Bloomberg Tech, and let's get a check on these markets. I'm going to take you to Verizon, because shares are higher after the company posted second quarter revenue that beat analyst expectations. You have to see 4.5%. The mobile phone company also raised its profit outlook, and it cited wireless price increases as well as US tax reform. Verizon CEO Hans Versberg spoke with Bloomberg earlier. Take a listen.
No, if you look at the quarter, and actually the last 4 quarters, our strategy is working. We have a lot of vectors of growth all the way from our broadband, fixed wireless access, our step-ups, prepaid is growing, and then we have our adjacent services with perks and all of that. So all of them are actually contributing. And then the last, I would say, 3-4 quarters have also been very good and disciplined on our cost levels. So we get the leverage. So our EBITDA was $12.8 billion, a growth of 4%. So we raised the guidance both for EBITDA, EPS, and free cash flow. All of them sort of coming from generation of good financials. But it's based on the customer offerings we have built over the last year. That is really resonating with the market, either on broadband or wireless. And for all customers, we're serving all customers in the United States, all the way from the governmental or federal customers to large enterprise, SMBs, and consumers. So that's what you see right now resonating with the financials, but ultimately it's about having the right offerings for our customers.
All about earnings this week. That was Verizon CEO Hans Versberg. Now, let's talk about how private equity firm Blackstone has just pulled out of a group of investors seeking to take a minority stake in TikTok's US-based business. And this is all according to a source who says the firm has ceded its potential stake to other investors in the consortium, which includes Oracle, Andreessen Horowitz, and General Atlantic. Now, coming up, Accel partner Ben Fletcher joins us to talk about one of Europe's latest unicorns. This is Bloomberg Tech. interest in AI coding tools remains high among users and venture capital alike. Accel has led a recent $200 million Series A round into Swedish vibe coding startup Lovable. And the startup has become Europe's latest unicorn with a valuation of $1.8 billion. For more, let's bring in Accel partner Ben Fletcher. So Ben, what stood out for Lovable? Why back it with such a significant sized Series A for European standards?
Yeah, I think it's a couple of things. First off, thanks for having me on. It's really great to be here and to chat a little bit more about Lovable. But when we spent time with Anton and Fabian, the two co-founders, it was really, really impressive to see that they were a really, really technical crew. So they had worked in research, they had worked in applied AI research, but they were building a tool that was applicable to the masses. So only 1% of the world's population can code, and then the 99% don't have that ability to code or to be able to create things for the web. And so when they looked at their experience of building applied AI systems, they were to be able to take that and put it to a platform that they built called Lovable that allows them to offer to their users the ability to chat or text-based prompt to be able to create fully fledged applications. So that's a front end with a back end and a fully working application. This was pretty incredible. If you talk with users, they say it's magic. And so all those things got us really excited to invest in Lovable.
I mean, the traction has been phenomenal. I'm interested as to who the traction then really ends up being with, because often it's the non-technical founder who just wants to sort of put together an initial idea of what the website, what the app looks like, and then they actually get a developer involved. How long until that developer is no longer needed?
The nice thing is it's been non-technical folks, it's been semi-technical folks, and technical folks that are using Lovable. You hear about the technical folks that are using it on the weekends, making it easier for them to get applications up and running, and then you see semi-technical folks, maybe the product manager or the person that has had experience in the past but wants to build something, or they want to be able to spin up a prototype and then pass it on to their technical or their developer team. And then it's folks that have never had any experience or don't understand frameworks or don't understand different coding languages, and their ability to actually get something spun up and to be able to build a fully functioning application. So all those folks are using it. We see this as a way to give the power to the masses to be able to create. So now if you have an idea, you can now build and you can have full software to be able to have a working prototype or also a working application.
Ben, I don't want to be sensationalist, but I'm interested, therefore, push us forward 10 years, 20 years. Developers, still a role one needs? Engineering, still something that someone's going into, software engineering?
I would say absolutely. I would say absolutely. Like you think about the engineers that are building a lot, and it's always been, how do we abstract more and more things over time? And so it started with cloud and with hosting, with AWS, and now you have it with applications. You'll always need maintenance. You'll always need the ability to, what are the right systems? How do you make sure that everything works together? And it will go more into the critical thinking and the critical aspects around engineering. Go ahead.
Well, now I'm interested in talent writ large a little bit at this moment, Ben, and you'll see why within my question. That you're saying how you've backed them because of just the sheer agility and expertise that Anton and team bring. Now I'm thinking of another coding application company like a Windsurf, for example, which also helps developers write code, and the fact that very elite part of the team basically got siphoned off, taken to Google, this licensing deal. Call it what you will, whether it's an acqui-hire or not, Ben. How are you thinking about structuring these deals going forward to protect all talent and your own bet on Lovable?
Well, the nice thing is that where we sit and where we partner, we're constantly partnering with entrepreneurs, and our idea is to make sure that we can align our interests with them to build the biggest companies as possible and companies that are really going to matter. Now, you're talking more around, M&A and acqui-hires and deals that are being structured from an enterprise perspective. For us, it's always about, one, how do we make sure that we can align our incentives incentives with partners, so with the companies that we're going to partner with, and then how do we make sure that we can support them? And we can support them to the best outcome and what they ultimately want. If they want to go and they want to work at these larger companies, that's great. We want to make sure that we can support them and make sure that they have the ability to do that. We'll also make sure that we protect our LPs and our investors and make sure that we can return capital to them. And so very similarly with Scale AI and with Meta, Alex had an incredible opportunity. And the amazing thing is that we still own as investors 50% of the entity going forward. And so we saw it as an awesome opportunity where a great company like Scale AI gets to go and reshape AI in the future, as well as there's a lot of value that will continue to be created and accrued over time to the investors and to our LPs.
Well, certainly Cognition thought that about Windsurf. So all can win in certain situations. Ben Fletcher, Axel partner. It's great to have some time with you. Thank you very much indeed. Now let's talk about larger trends in venture investing too. And PitchBook has released its funding data for the first half of 2025. Senior venture capital research analyst over at PitchBook, Emily Tsang, joins us now. And Emily, look, one of the focuses has been M&A as an exit. How much are these acqui-hires bringing numbers in terms for you on what is happening in PitchBook data?
M&A activity has been really interesting because a lot of startups are really leading this trend. Because of the FTC leadership hasn't really changed much in the M&A landscape, this has really led a lot of large startups to be the forefront of acquirers. But I think what's really interesting and what the biggest topic in Q2 was IPOs. IPOs did come back modestly, but I would say it's more of a reset rather than a rebound.
Okay, so we're now thinking, well, Figma is the one to watch. They're already on their roadshow, Emily. So is that going to be yet another one that helps push open the door, or really are we going to have a trickle effect when it comes to IPOs?
Currently, there hasn't been a really rush towards new filings, mainly because of the August 1 tariff deadline that hasn't addressed a lot of key policy questions that still need to be answered. For Figma specifically, what's interesting is that it's an older company. It's about 13 years old, and it also has a really large crypto balance. And a trend we've been seeing recently with the new Trump administration is sectors that are focused on key policy priorities like crypto, AI, national security, defense, and fintech has really propelled recent exit activity.
We're just hearing about Bullish looking to IPO as well, so another one that adds to that crypto vibe, Emily. What about just more generally liquidity needs? What takes people to the market is because often it's your employees, the VCs that have backed you that want this moment. Are you seeing liquidity needs, though, be satiated in the secondary market a lot more?
The secondary market is really interesting and has been growing rapidly. I publish a quarterly report on this at PitchBook, and the market currently is about $60 billion, and that's significant, and that's the annual value as of Q1. But $60 billion, for context, is about 2% of primary unicorn valuations and about a quarter's worth of primary VC exit value. So it's notable, but it's also not big enough to be the new IPO, for example. And with the secondary market, it's important to realize that the concentration is super high in the top 20 to 50 unicorns. So unless you're an investor in one of these top startups, you're not necessarily benefiting much from the secondaries market right now. But there is a lot of growth in the space. The number of funds that have invested in VC secondaries, the total fund value has doubled since 2022, which really shows investor interest in the secondary space, and I do foresee it continuing to grow.
Emily, you talk about that concentration when it's looking at those that are able to tap the secondary market. What about concentration on those that can ultimately come for an IPO as well? I mean, it's no surprise that Figma's probably going to be leaning in on its AI advantages. Is it still all about Gen AI in that trend?
AI is really dominating VC right now. It's captured about 2/3 of the deal value in 2025, but only about 1/3 of the deal count, which really shows the concentration in AI. And I think AI will continue to be a really big theme. Of course, foundational models have captured a lot of VC dollars and interest, but what's also really interesting is that AI is fundamentally changing how businesses are operating and their fundamental models throughout a variety of sectors. So AI is really transformative, and that's why venture is funneling a lot of dollars into the space.
And lastly, are we talking very much, I know you focus on the US in terms of the data, but what does it look like globally? Is still the US the nexus when it comes to at least coming and tapping the IPO market, and more companies coming internationally to tap that market?
The U.S. is currently still dominating the IPO market, and in general, across the world, deal-making and exit activity has remained muted. Venture really doesn't like volatility, and there has been a lot of volatility recently. And until some key questions are answered, like the Fed, for instance, tariffs, trade wars, geopolitical tensions, there probably will be muted deal-making and exit activity until those questions are answered.
Emily Tsang, we thank you so much, Senior Venture Capital Research Analyst over at PitchBook. Great to get the breakdown. Chicago. It is host to the Global Quantum Forum happening this week. This is where top industry leaders are set to discuss the future of the sometimes hyped technology. Let's join Jeremy O'Brien over in Chicago. He's PsiQuantum co-founder and CEO. PsiQuantum is currently building out a quantum computer campus in Chicago. And Jeremy, before I ask exactly what you're going to be doing in the force of quantum, but first, why was Chicago the place to be spending, I think at least $1 billion is what you're committing in capital?
Yeah, so Chicago, we figured it was the best place in the world to do what we're doing here, which is building the country's first utility-scale quantum computer, and that's really about an understanding that folk here have of just how big and hard it is to build a system of that scale.
Let's talk about, therefore, the application, because I maybe loosely say that quantum is often hyped. The hype is around just when it can be purposeful, when it is going to be really, truly useful. We have breakthrough after breakthrough. Jeremy, how are you going to be offering something really useful for commercial purposes?
Yeah, you're right. There has been a lot of hype and a lot of talk of breakthroughs, and fundamentally, my view is that breakthroughs precipitate a decade or more of hard work, real hard technological development. It's not breakthrough and then suddenly you have a new technology, and that's certainly true with quantum computing. And so our breakthrough was a decade ago when we were university professors, and we figured out a path whereby we could leverage the semiconductor industry and the trillions of dollars that have gone into that and adjacent industries to build the real thing, which is a million qubit scale, fault tolerant utility scale quantum computer. And so that's what we're doing right here in Chicago.
You're a professor over at Stanford, at Bristol universities as well, Jeremy, and I'm thinking about how photonics has become the area of real focus for you. How does that differentiate you from what others are doing?
Yeah, so you're absolutely right. It's the silicon photonics platform that we spent 20 years figuring out what's the platform that enables us to leverage that semiconductor industry. Because it's been my conviction since, I don't know, the mid to late 90s that unless we figure that out, it's not going to happen in my lifetime. And when we figured that out, we established PsiQuantum, and we spent, many years and much blood, sweat and tears grinding away at the really hard semiconductor engineering problems to make that work. And now we're at this point where we're poised to break ground and build that facility here.
Can you, I hate to say put yourself against the competition, but when you've got IBM out there saying here in upstate New York, we're going to be getting there by 2029, a real use case quantum computer, Jeremy. You've got the race on with, companies you've helped advise before, when I'm thinking what Microsoft's up to, AWS and Google. Where are you in comparison to that race, as we like to put it?
Yeah, firstly, I'm not sure that it's a race when it comes to hard technologies. In some sense, it's a filter, right? But I can't speak for all the other different folk that are out there pursuing this. But I can say that our approach has been very different from the beginning, which is to really focus on the scale that's required for really valuable commercial applications. And it's been the case for 25 plus years that that's a 1 million qubit scale system. And so we have had nothing to do with doing small demonstrations, proofs of principle of quantum computing. And that's been a very deliberate approach, because it's a bit like, if you're trying to get to the top of the Sears Tower here in Chicago, then ladders are a good way to try and get to the top. But if you want to get to the moon, ladders are not really the way to get you there. And so we've taken a pretty antithetical approach, I would say, from the beginning, which is to really focus on scale. And so when you're talking about a 1 million qubit scale system, as I said, it's been clear to me for a very long time that the only way to be able to do that is to leverage the $1 trillion and better part of a century that went into the semiconductor industry.
And leverage
so that's what
a billion that you're going to be investing in that project. And you take us to the Sears Tower, I go back to Chicago. What has the workings been like with the governor? Why have you managed to think that that is going to be where the talent pool is basically for you going forward?
Yeah, I think from the governor to the alderman and the entire ecosystem, we've really enjoyed great partnerships here. And it's been driven by, as I said earlier, the understanding of just how big, complex and hard this project is. To build a utility scale quantum computer, that's a very big, hard project. And I'll give you just one example of that. Early in our interactions with the city and the state, a big delegation came to us in Silicon Valley, led by the deputy governor, and the head of ComEd, the power utility, came to that very first meeting. And I think that's a big differentiator for us as an organisation and for the ecosystem here, is to understand that, we need to get we need to get power to the site, et cetera, et cetera. So that's a really big part of our decision.
Well, Jeremy, have a great time at the Chicago Quantum event. You are, of course, Jeremy O'Brien of Psi Quantum. Now that does it for this edition of Bloomberg Tech. Quick check-in on the NASDAQ, which is at a record high once again. NASDAQ 100 too. We have got earnings thick and fast this week. We brace ourselves for Wednesday with Tesla, Alphabet and IBM. Don't forget to check out our podcast as well. This is Bloomberg Tech.